Good afternoon, everybody. Today is our special guest, David Monroe. David is a CCIM instructor and a multifamily investor. He's a broker as well. He specializes in the market analysis. As a CCIM instructor, he not only teaches market cycles and feasibility analysis, but also after tax savings and other strategies. He used to own a multifamily property management company as well. And he is expert in asset management at the operational level. We are very excited to have him as our guest today and looking forward to learning the market analysis techniques from him. David is very passionate about building strategic partnerships, and I'll put his contact information towards the end. Please feel free to reach out to him. All right, David, thanks. Are you good to share?
I should be sharing my screen. Can you see it?
Yes, I can.
Okay, good deal. Thank you, Vinky. Really appreciate it. So this is a webinar I've done many times and for different folks. Vinky asked me to come on and do it for you guys. So sit back, relax. Takes about 35 to 40 minutes, depending on how much fun I'm having. So if I'm having a whole lot of fun, it'll go a little longer. But I know this material like the back of my hand. So without further ado, let's get started when we can get the technology working correctly. There we go. All right, so what am I going to cover today? Well, the first thing we're going to do is we're going to understand current multifamily market cycles, how to identify where your market may be in a cycle. And I will go through each stage and show you how to do that. And then we're going to have a little bit of fun. And we're going to look at the stock market and how stock market investors kind of do their market cycle. And you'll find some similarities there, but we'll have a little fun with that one. Then we're going to see where do we actually go to find data. So there are different resources. There is free resources and there are paid resources. We'll cover both. And then we'll actually go in and see how to calculate current multifamily demand. And then I'm going to tease you a little bit, just a little. I'm going to tease you and show you that you can estimate future multifamily demand. Yes, we can predict the future and we can use math to do it. I'm going to stay very high level on that one because if I do go into detail, we might be here for about 4 hours, which is about what it takes me to teach it for the CCIM Institute. So we're not going to go that deep. I'll spend about 10 minutes on estimating future demand and just give you a little bit of a teaser on that. Okay, so a little bit about me. I am David Monroe. You can see I've got my phone number there as well as my email address. As Vinky said, feel free to contact me. I am an open book. So I am a multifamily investor, broker, and consultant. And as it stands right now, my focus is building strategic partnerships with the investors, syndicators, and sponsors that are in the trenches doing the deals right now. If you want to learn more about that, reach out to me and we can have that discussion. I'm also a certified CCIM market analysis instructor. I'm what's known as a junior instructor. There are 3 levels. The first level is called workshop leader. You have to teach 3 times and then you can get promoted to junior. You actually have to go through a board and be approved. I am 2 levels deep. I've taught 2 as a junior. I still have 2 more to go before I can qualify to be a senior. I'm also the Florida CCIM VP of Education, which means I'm on the executive committee for the state of Florida, which is 1 step away from being the Florida president, which I don't want to be. That's a little too political for me, but I love education. So I did agree to be VP of Education for them for this year and next year. I'm also on the CCIM Tech Board. I'm very passionate about technology and I'm on that board for the next 3 years, as well as the CCIM Foundations Board, which is the raising money arm of the CCIM Institute and is the entity that provides all the scholarships for CCIM. A lot of you may have seen some of my posts relating to the Veterans Scholarship that we have just created. That is from my relationship with the CCIM Foundations Board. Okay, so that is me. Enough about me. Let's talk about you for a while. Yeah, just kidding. All right, understanding the current multifamily market cycle. Uh-oh, I'm already starting to have fun. Watch out. Let's see. Well, before I dig in, just looking at questions. Okay, looks like Vinky's got control of the questions. Understanding our current market cycle. All right, so this is a market cycle. For those of you that want to know how I drew that, there's an app called Limu, Limnu. I don't know. If you look up drawing apps, it's just SaaS software, Limu, and I can't think of how to spell it right away. Well, probably Limu would be, but I think there's an N in there somewhere. Anyway, we're not talking about technology. So we start over here in phase one. We have four phases to our cycle. This is a market cycle. Back in 2010, 2009, 2010, we're sitting down here at the bottom, or maybe in between the bottom and this first point. Okay, so here we're going to still have high vacancy. This is our long-term occupancy average or long-term vacancy average. Just depends on whether you're an optimist or a pessimist. And so as long as we're below that long-term average, we stay down here in recovery 1, or we stay over here in number 4, recession, but you'll see how we get here later. And we do have some markets that are over here right now. Not too many over here. Although some will argue retail's already maybe hitting this bottom point. Anyway, we're not here to talk about retail. So on this section of our market cycle, we've got some decreasing vacancy, though we're below long-term average, but we may still have some rent decline or maybe some stagnant rent. But because we've got that rent decline, the units are starting to fill up, so we're starting to climb a little bit. As we get above this third point right here, we actually start to get a little bit of rent growth and we start to get some acceleration. So now the market's really starting to recover. So we're sitting here probably 2011, coming out of the Great Recession, and we cross the long-term vacancy average for most markets is somewhere between 5 and 7%. Mobile, where I'm from, where I live, our long-term average is like 9.1%. We're currently sitting at 7.2%. Okay, so that means we are above this line. Now, whether we're in 2 and 3, we'll figure that out later. When we get to this green circle, so rents are continuing to increase, vacancy is decreasing, we can consider this line here our NOI line. So as rents are going up, vacancy is decreasing, occupancy is increasing, concessions are decreasing. We can pretty much assume that our NOI is climbing. So as we climb up our NOI ladder, we start to climb up through expansion, and we get to a point where we can start building new product. We get there because the rents are now high enough that we can afford to build new construction and still get about a 2% cap spread, because developers aren't going to build if they can't make money. Okay, so that starts to happen about here. For multifamily, that was right around 2013. Right, then we started seeing permits come in. About the time we get to here, maybe even between here and here, we start to see new construction happening, dirt's beginning to move, and as we get in between here and here, we start seeing deliveries hit the market. When the deliveries first start to hit the market, which happened 5 years ago or so, the demand way exceeds those deliveries. And so we still stay on this side of our equilibrium line, and I'll talk about equilibrium in a second, but we still stay over here. So deliveries continue, they continue. Rent growth happened. If you remember, 14, 15, 16, we had some of the highest rent growth years multifamily had ever seen. Some markets 11, 12, 13%. But as construction caught up and those deliveries kept delivering, it started to slow down. We started to kind of get real close to this equilibrium point where rent growth slowed. So we went from like a 7, 8% rent growth to 2, 3% rent growth, which was pretty normal for a normal transition in a market. And so we started to hit this equilibrium point, and when demand and supply are equal. So if the market says we need 20,000 units and our current inventory is 20,000 units, we're in equilibrium. Now, as we continue, because remember, we started construction here, we're still starting construction here because developers haven't identified yet that they're in equilibrium. So we are still building over here as we go into oversupply. Now, rent could still be growing as you're going into oversupply, but the vacancy is starting to tick up a little bit. Okay. So we're starting to head down. This is that vacancy. So, you know, our NOI line. So if our vacancy is ticking up, but our rents are still increasing, we know our NOI is starting to drop. Okay. Because that rent growth can't sustain with those vacancies. So we start to drop. Once we get past this point, we start to get to the point where now our rent growth is either now zero or decreasing. We're accelerating now a little bit faster. We're still delivering here. There's some cases where we're still building here, and you'll see that when we get into Dr. Muller's cycle report. I'll show you what that looks like. But we could still be even building here, but now we're really accelerating. The deliveries are way over exceeding the demand, and that puts us right through our long-term average again. So if this is Mobile, now we've dropped to 90% occupancy, 88, 85. Our rents are decreasing, and owners are going, oh my God, what do I got to do? What do I got to do? And they wait too long before they sell. So if I'm a buyer in the market, this is me. I'm going to guess Jim Biggs is probably the same way. I'm going to guess that Daryl Murphy's probably the same way, that we're buyers here for sure. Definitely here, but we're buyers here. Okay. Because you want to be able to buy so that you can still absorb a little bit more loss and be able, and you're going to be doing some renovations during this period anyway. So you're going to have loss regardless until you get to that bottom so you can ride that wave going up. Right. So hopefully right around here, if you're buying here, hopefully around here, we're starting to deliver new units and we're starting to go up the other side, which is back over here again. I've had some people tell me, well, I'm not buying until I get between here and here. Okay. That's fine. That's your risk. All of this has to do with risk. Okay. So where on this NOI line you want to buy is completely up to you. For me, I'm on the downswing, hopefully, if we can time it right. Okay. That is the market cycle. So phase 1, phase 2, phase 3, phase 4. We call this recovery, expansion, oversupply, recession. There is a guru, and everybody that knows me knows I really love gurus. David Lindahl teaches this. So buyer's market phase 1, seller's market phase 1, seller's market phase 2, buyer's market phase 2. And that's how David Lindahl, if you guys have ever read his emerging real estate markets, you get one chapter of market and then you get the rest of the chapters repeat of Multifamily Millions. Just saying. Although Multifamily Millions is still the best value add apartment book on the market until I write my own. Just saying. All right. Again, I'm having fun. So that means we're going to be here a while. All right. So here's Dr. Muller's third quarter report. Now, I know a lot of you like to go pull the IRR reports because it'll give you cap rates. Okay. Keep in mind, those are projections. They're not accurate. They're just projections. Dr. Muller's report is actual data, even though it's lagging 2 or 3 quarters. Now it's lagging 3 quarters right now because of COVID, but we do have the third quarter 2020, as you can see here, for the apartment market. I'm not going to pull up the national. I'm not going to pull up the other product types. We're just going to look at third quarter 2020. These are the top 50 MSAs in the country. Really, I think there's 55 here, but I like to say top 50. And you'll see that our worst market, and I have a young lady that I mentor. She's a commercial broker in San Jose, and we have looked at the data and we agree San Jose is definitely here, maybe even 0.15, because of when COVID hit. Think about what happened to Silicon Valley. San Jose's in Silicon Valley in California, for those of you that don't know that. When that happened, you had all those tech companies sent everybody home. They didn't just send them home, they sent them home to work. Well, then those employees realized, oh my goodness, you mean I don't have to pay $4,000 a month for a 400 square foot apartment? I can go move to off of Highway 580 and 680 or Interstate 580 and 680 over in the Pleasanton area and, you know, maybe pay half that in rent and get a bigger place. That's what I'm going to do. And whoop, off they went. And so that's why San Jose is looking the way it does. Now, Silicon Valley's resilient. It always comes back. It always leads the downtrend. It always leads the uptrend. So we'll see whether that happens this time, because we really don't know what's going to happen with all the companies moving out of Silicon Valley and moving to Austin and to Boise and some other areas. So we'll see how that gets affected by it and whether they can actually return like they normally do. So they're doing what they always do. They lead coming down. We'll see if they lead going up or if they get overtaken. So if you see this +1, that just means last quarter, San Jose was here. Dr. Muller moved it to here. You'll see here, Denver's -1. That means last quarter, Denver was at 0.13. Dr. Muller moved it back to 0.12. He can do that. He lives in Denver. I think he probably has a pretty good idea of Denver's market. Okay, so you can just see where they are. Notice we're in hyper supply, 0.12. So if you look at a lot of these markets like Nashville, we all know Nashville still has great rent growth. They might be ticking up a little bit slightly in vacancy because of all the deliveries that are occurring, but the demand is keeping up with those deliveries, but those deliveries have put it across the equilibrium line and over here. There's a good chance if the construction slows down in Nashville, National will end up back here at equilibrium. Okay, a lot of these markets, look at Austin. Now, reason Austin's over here, same thing. You've got what, 30,000 units under construction in Austin? It's crazy, but they are keeping up with deliveries. Same with Dallas. Dallas is keeping up with deliveries. Dallas still has 32,000 under construction. But as long as they keep it up, Dr. Muller will keep it here. Hopefully you guys are understanding this. And you can see here's that green 8, meaning we can start to build here. We don't have anything sitting over here. Now, these are all primary and secondary markets. I'd venture to say that most of your tertiary markets that weren't affected by COVID too badly are probably sitting here at 9 and 10. Mobile, I can tell you, is definitely sitting around 10. Huntsville's sitting around 10. Although Huntsville's creeped into equilibrium very quickly, but that's because when the Mazda Toyota plant finally delivers, which is supposed to be this fall, we're going to have a rush of 3,000 employees and all their families coming to the Huntsville market. And they've got about 3,200 under construction right now, 3,200 units to try to meet that demand, because you'll find out here in a minute, it isn't just the 3,000 employees coming that they've hired initially. It's going to be a multiplier of that from everybody else that's coming to the market. You'll find that out in a minute. All right, so that is Dr. Muller's report. Here is the Wall Street report. Okay, this is kind of fun. So if you think about it, down here we're kind of in phase 1 down here in recovery. So as the market starts to tick up, now this is the stock market, you've got investors that are down here in disbelief. They start to see this thing go up. They're like, this thing will fail like all the rest of them have. It's a sucker's market. So you start to get some hope. So you continue to see it go up, and then whoop, we got this little dip, and we kind of go stagnant a little bit. It's like, recovery might be possible. Keep it in mind, we're not investing yet. So the investors aren't investing. They're still sitting on the sidelines as this continues to tick up. Now we got some volatility like we'll see every now and again, and it really starts to go up. Now optimism kicks in. We still haven't invested. So we wait until it gets way up here into belief, and now it's like, all right, let's get all our money in. Let's start putting it in. Let's get it in. Let's get it in. And they throw all their money in the market, and they ride this thrill ride all the way to the top until they're like, I'm a genius. Yes, I beat this sucker. And they leave their money there. And then wham, a big correction happens. And we see this happening all the time, right? And so now we get this volatility in the market. And the investor's like, all right, it's up, it's down, it's up, it's down. Okay, we see this correction here, little adjustment there. Yeah, we know we're okay. It's going to continue to go up. So complacency sets in. It's like, we just need to cool off for the next rally. That's all it is. And then we get this big spike down, boom. And it's like, oh, wait a minute now. Anxiety starts to pop in. And it's like, now we haven't sold yet. Remember, we bought here. We're still holding our money here. It's like, oh, big volatility. And wham, they've got this big one that happens. It's like denial. It's like, oh, all right. And we get this spike up. It's like, okay, my investments are with great companies. I got all blue chip investments. They'll come back. They'll come back. And boom, another big one happens, like really, really big. And then panic hits. And you're like, oh, crap. Sell it all. Sell it all. Get rid of it. Get rid of it. And then boom, it goes all the way down and capitulation sets in and you're like, that's it. I screwed up. So I bought here, I sold here, and I'd be willing to bet that everybody on here believes that you're supposed to buy low and sell high, not buy high and sell low, which is what all these stock market people seem to do all the time. Now, keep in mind, this is long-term investors. This isn't the day traders. And so then we start to get angry because it's going up, it's going down. You got this big tease. It's like, all right, who shorted the market? Why'd the government do this to me again? This always happens. They blame it on everybody else but themselves. And they're watching it. It's stagnant. It's kind of coming along. We're down here in this recessionary phase and depression sets in. It's like, there goes all my money. My wife left me. I ran over my dog with my truck, and then I totaled my truck, and it's just big depression kicks in. And then the market starts to climb back up again. And it's like, this is a sucker's rally. I don't believe this. And you're right back over here again. So you really have this cycle. If you look at it, it's not much different than ours. It's more of a, U-shaped instead of kind of like ours is. Well, it's a bell curve, just like ours is, only we kind of show that little dip on both sides. But if you look at this and you think of multifamily, where I like to compare this right now is everybody with our low interest rates, with the government keeping the COVID situation propped up by throwing all this money into the market. It's like we're artificially being propped up right now. Everybody's in euphoria. They're still buying like crazy, but we're also in complacency. So I'd argue that we are sitting right in this area right here in multifamily. And if you are being complacent and you're not paying attention, you're going to be seeing some anxiety coming in the near future. Okay, just my opinion. I think we have a correction coming, not for all markets, not for all asset classes, but we got a correction coming, and anxiety is going to start to hit the board really fast. And if they don't get out before denial, well, we all told them, hey, we told you should have sold to us 2 years ago. You didn't listen. Now look at you. Now you're giving it to me at 50 cents on the dollar. Appreciate it. Thanks. All right. So I had just a little fun with that. All right. Any questions on market cycles before we move on?
I have one question for you, David.
Yes, ma'am.
So this is a pretty awesome, actually. First of all, I wanted to commend you on that, just giving us this much detail on the market. But regarding this market cycles, I mean, looking at the history, or I would say using some past events, can you predict, or can you tell us a little bit how long each cycle is typically? Or is there a way to predict that?
Not really. I mean, think about what we just went through. We just had our longest bull run in the history of the country since we started keeping record of it. Every market before then typically was 5 to 7 years. You even had some people trying to time when this market was going to adjust. And if it wasn't for COVID, we'd still be riding high. Maybe not because of all the deliveries. The migration was happening anyway. COVID accelerated the migration out of California, out of New York, into Florida, into Austin, into Dallas, into Boise. But COVID kind of accelerated that migration. It just went faster. It was coming anyway. So there's really no real way to say from past performance what future results will give us, which is why we need to do calculations in order to determine all this, okay? Which we're about to get into. Let's see. Ray says, can you give general strategy for each cycle, particularly cycle number 3? Also, do you agree with Lindahl? All right, Ray, save that for the end. We'll answer that towards when we get into Q&A. All right. How to calculate current multifamily demand. We're not going to do any math yet. We got to know where we got to go to get that data first. Okay. So everybody write this down. Write this down. Census Quick Facts. Okay. I'll put it in the chat. So let me copy that. I'm going to come down here. I'm going to paste that there. Okay. That Census Quick Facts. Quit going to city data for your information. Go straight to the horse's mouth. All right. All city data does is API into the US Census, and their data is not as updated as Census Quick Facts is. Okay. Just go to Census Quick Facts and put in your city. Now, first one to type in their city in the chat wins. Give me a county. Give me a county. I want a county. Kitsap. Where the heck is Kitsap? I have never heard of that one. Kitsap, Washington. All righty. So if you notice, Kitsap County, Washington is now right here side by side with the United States. Okay. I could even put in, give me a city in Kitsap. Who's that, Betsy? Give me a city in Kitsap, Betsy. Silverdale. All right. So let's go Silverdale. And we'll see Silverdale CDP. So it's a small city. All right. Now you'll see we're benchmarking now. Good luck getting city data to do this for you. So now I can see everything for city Silverdale, and it looks like census doesn't track some things. We've got the 2010, so they're not estimating. So wow, Silverdale must be really small. Then we can benchmark it against Kitsap County, and we can benchmark it against the United States. You can even go down to a zip code if you want to benchmark a zip code against Silverdale. So my guess is there's only one zip code in Silverdale seeing this information. What this means is I can do, zip, city, county, state. I can do county, MSA, state, US, but you can do up to 4. All right. You guys get the point here. But what are we looking for? We're looking for population. So we want US population. In this case, we're doing Kitsap County, 271,000 in Kitsap County, right? Then we want to come down and we want to see housing. So here's our total housing units according to census. We're going to compare this. Again, this is a guesstimate because they only do every 10 years when they do the census. We're actually going to put math to it and see what's probably actually there. Owner occupied is a big one for us. We have to do the inverse of this. So it says there's 67.8 in Kitsap. So that means it would be 32.2% renter user ratio. We call that tenure. You'll see it in a minute. Keep coming down, and you got households. You got all kinds of different information here. All right. So this is where we get our census data. Do not get employment data from a census website. Get your employment data from Bureau of Labor Statistics. So if you're doing any kind of employment information, go to bls.gov. Go to the horse's mouth. Stay off city data. Best advice I can give you. Okay. So let's go back to the presentation. What else do we need? Whoa, that was cool. All right, so we also need supply side data. So we're going to need vacancy. We'll need other supply side data later, but in our calculation for just current demand, all we need is vacancy. And in order to get vacancy, we've got to go somewhere to get it. I'm not going to go to citydata.com to get it. I'm not going to go to best cities to get it. I'm not going to go to BLS. I'm not even going to use census.gov to get that information. We need actual data of the market on what the market vacancy is. So I'm going to go to CoStar. I'm going to go to Reese, Yardi, Axiometrics, Real Capital Analytics, or I can go into the market and survey it myself. Some people will go to like apartments.com and try to get rent data. Yeah, okay, maybe not. Some will go to, what's that, Rent-A-Meter to go. It's a very inexpensive one. It will give you some rental data around the property. The problem is you can't control where that data is coming from. So you may have a property 3-4 miles away that you can't see because it doesn't map the data in Rent-A-Meter. So you don't really know if that's really a true rent comp or not. So the point there is, don't go pay $2,000 a month for CoStar. Don't go pay $500 a report for Reese. Don't go pay, $750 a month for Yardi or Axiometrics or Real Capital Analytics. Build a relationship with someone like me, Daryl, other brokers that have access to this data, and just ask us. We'll give it to you. It doesn't take us 5 minutes to pull the data, okay? But you're going to need your vacancy data from that. All right, so what are we looking for? I told you already, we need total population, and you'll understand why in a minute. Remember I said the owner-renter ratio was called tenure. That doesn't mean that you're on salary and you can never be fired. It just means, it's just a term we use to delineate between the renters versus the owners in a market. Why? I don't know. It's just what we call it. Okay, then we need average persons per household. We get that from Census Quick Facts. Non-household population, group quarters, okay? You cannot get this information. You may be able to Google it and find it for some areas. Again, find a CCIM in your market that has access to ESRI or site to do business, or, just contact me or a CCIM candidate. Candidates also have access to site to do business. Within our market profile report, we can pull group quarters. There are ways to get group quarters for some markets, but not all markets. I've got ability to get it in every market. Most CCIMs do. Most CCIM candidates do. Group quarters are your like hospice that aren't at home, that are in a hospice area, assisted living, like memory care, nursing facilities, things like that. Prisons, student housing on campus, military on base. Those are all group quarters, okay? So we do not calculate the population for group quarters in our calculation, so we have to subtract them out. And then we add back in our vacancy allowance. And the reason we do that is because we never want to be at 100% in the market. Otherwise, if we have Mazda Toyota wants to move here, build a plant, we got nowhere to move employees because we're 100% in the market. So we always want to have a vacancy allowance and try to keep our market at that vacancy allowance. All right, guys, ready to do a little math? Okay, Monroeville. For those of you who know me, know my last name is Monroe. I use Monroeville. This is a fictitious town, even though right above Mobile County is Monroe County. And guess what the capital of Monroe County is? Monroeville. I don't know what to tell you. It is what it is. Okay, in Monroeville, I've got a population in my Monroeville of 100,000. I like nice round numbers, keep it simple. Okay, I need to subtract out those group quarters. So I went to Census Quick Facts, and I saw in Census Quick Facts that my total population for 2019 or 2020, depending on what you see in the Census Quick Facts will give it to you in 19. I can get 2020 data from ESRI. Either way, it doesn't matter. It's close enough for government work. So it tells me I got 100,000. Now I go to ESRI, I get my group quarters. You go to a CCIM, they give you the group quarters. You subtract out those group quarters. That tells me I have a gross household population of 99,000. So far, for 100,000 people in the market, this is my demand. My demand is 99,000, okay? Next, I need to know how many people per household are in the market. Again, Census Quick Facts is going to give me this information. Not best cities, not city data, Census Quick Facts. So I divide that 2.5 by the 99,000. Let me go up here and get my little, I'm missing my little cursor. Let me just give me a second here, spotlight. Okay, so I take 99,000, I divide it by 2.5, and that tells me that I have 39,600, okay? That means there needs to be 39,600 rooftops for 100,000 people. That's owned, rented, condos, you name it. 39,600 total in the market for 100,000 population. But David, we're doing multifamily, right? Tenure. So now we're going to put tenure in the market. All right. So I'm going to say that the tenure for Monroeville is 32%. Okay. Pretty common. Usually between about 28 and 48% is pretty common for most markets. I did see a market recently, and I don't remember which one it was like 69%, just renters. Crazy market. That's where I want to invest. Anyway, occupied housing times tenure, so 0.32, because it's 32%, tells us that we have occupied, now typo, shouldn't say multifamily, should say rental units of 12,672. Because included in this are going to be all your single family rentals. Now, you used to be able to go to Zillow, and you used to be able to pull up in Zillow a map for if you wanted to lease, and it would show you which ones have rented, and those would be in yellow. And then it would show you what is available, and those would be in green. And it'd even give you the amounts. So you could count each one in the market that you're trying to do. And so you could figure out how many rental units there are in for single family in that market. but Zillow took that map away about a month ago. It is gone. You can no longer see that map. So if you find a resource, I'm out looking for a resource right now, willing to pay for it. You find one, let me know. Or for you tech people out there, it's time to build a resource so we can get single family rental demand data and supply data. Okay. We need that. I don't have an answer for that right now. So you've got to put a little, you got to know your market, got to put a little guesstimate in there, maybe use a little ratio. I tend to use about, depending on the market. So for Mobile, we have a lot of rental homes in Mobile. So I'll use 20% for Mobile for single family rentals. You just have to be able to determine in your market what you believe that ratio is. Good contact would be leasing companies, management companies, realtors that have access to MLS. They could probably go in and count that inventory for you. I'm just trying to find a resource I can find online that I don't have to call somebody to get it. Okay. Now I need to take, because that's at 100% occupied. So at 100,000 total population, that tells me I have a demand of 12,672 units in the market, because I have a household population of 2.5 and a tenure of 32%. But that's at 100% occupied. I don't want to be 100% occupied. So I want to divide back in. I want to add in a vacancy allowance. Well, let's just say Monroeville 7%. Mobile just happens to be 7.2 right now. So you got to do 1 minus the vacancy allowance. So if my vacancy is 7%, 1 minus the vacancy is 0.93. Okay, that's how you do that. Or 1 minus 0.07 will give you 0.93. So if I take 12,672 and I divide it by 0.93, that tells me that I've got a total multifamily demand of 13,626 units. Now, again, total rental demand. That's condos, that's single family homes, that's townhomes, you know, everything that's a rental in the market. We need 13,626 units in order to satisfy 100,000 demand. That's it. It's that simple. That's multifamily demand. That's how you pull it. It's not rocket science. So let's determine whether we're in oversupply or not. So now we go to CoStar, Yardi, Matrix, or Reese, or Axiometrics, or any of those others, and let's determine whether we're in oversupply or whether we have a gap, meaning there's a demand. Okay, so real simple, demand minus supply equals gap. You are going to hear me call it over and over again, demand supply analysis. You guys are going to think I'm dyslexic when I say it, but I say it because demand minus supply equals gap or oversupply. Okay, that's why I call it a demand supply analysis. I would encourage all of you to retrain your brain to do the same thing. Just saying. So we just determined we have a demand. This includes our vacancy allowance of 13,626. I go to CoStar for Monroeville. CoStar tells me I got 14,200 units in the market. So I subtract demand minus supply. I can have a negative number, which is what's going to happen here, will tell me that I have an oversupply of 574 units. So Monroeville really probably isn't at 7%. It's probably at like 8 because it's such a small market, probably 8.3, 8.2, somewhere in there is probably their vacancy. Does that mean I don't want to invest in this market? That is not what that means in any way, shape, or form. It just means that we are slightly in oversupply. And if we go back to our, model, if our long-term average is 7% and we're sitting at 8, maybe we're down in either 0.4 or stage 4 or stage 1 if we're below that long-term average. If we're starting to see some growth and we've got a little past numbers to tell us we're climbing up, maybe we're in 1. If the market's been going down, maybe we're in 4, but we can't identify that by just looking at the demand here. Now we've got to look at some other data to plot it. We can do that in a future course. Okay. Any questions on how to determine current demand? Because I'm about to go ballistic on you. Y'all's brains are about to explode on this next part. That was the easy stuff. I just saw something pop into Q&A. What was that? Can you repeat how to find tenure? Okay. Census Quick Facts. So if I go back to Census Quick Facts and I scroll down under housing, owner occupied housing unit rate, you'll see for Kitsap County, it is 67.8. You want to get the inverse of that. So 1 minus 0.678 will tell you that it is 32.2%. That answer your question, Miriam? Ah, perfect. Thank you. Wonderful. Wunderbar, as they say in German. All right, let's keep going. Future multifamily demand. So this is the big boy here. Okay. This, if you can do this, there's no stopping you. All right. This is where the rubber meets the road. We teach this at the CCIM Institute. Okay. How to estimate future multifamily demand. If I can get my technology to work. There we go. All right. So we have to do a couple of things. We have to determine the economic base analysis. That is the first step. Now, it's actually a multi-step process, and we're going to go over economic base analysis pretty extensively, but we got to do something first. We got to look at jobs and we got to look at population, but we got to look at something very specific with jobs. And we're going to spend a little bit more time on that here in a minute. Once we know our jobs, we can then determine what our future populations are going to be. Yes, you can predict 12 to 24 months from now what your population is going to be in your market by just using a little bit of math. It ain't easy math, but it's math. Okay. You just got to know where to find the data, how to interpret it. So the first part, there's two parts to economic base analysis. Part one is finding your current economic base. There's 4 parts to that, and we'll go over each one of those parts. And part two is getting your future economic base. So we're looking for 2 things in current economic base. We need to find the economic base multiplier, and we need to find the population employment ratio. When we have those 2 things, we can then determine future economic base. Okay. If you remember, I told you Mazda Toyota's got 3,000 people over the next 6 months coming to Huntsville, just a rush of 3,000 employees and their families. But it isn't just those 3,000. We're going to take that economic base multiplier. We're going to apply it to those 3,000 and find out that it may actually be more like 17,000. Now what the heck are you going to do? And that's why there's so many units that are being built in Huntsville. Okay, so let's look at current economic base, 4-step process. First, we have to identify industry sectors with basic jobs. What the heck's a basic job? All right, this is where the gurus don't tell you what you're actually supposed to do. They're right. You need to find markets that have growth and employment. But if Jim Biggs opens a bakery shop over on Hillcrest Road and hires 6 employees and makes muffins and bagels for the local market, I'm sorry, but those 6 employees are not counted in my economic base. That money's coming from the market and it's being paid back to the market. That's just local money circulating. We do care about jobs. We just don't care about that money circulation. Okay. What we care about is Mazda Toyota coming to Huntsville, because we know where the money's coming from. We can follow the money. We know that that money's coming from Japan and paying those employees at that plant. And then they're going out in the market and they're paying for their mortgage or their rent or their utilities or their groceries or their clothing. But they're not just spending their money in the market. Maybe they're going up to the Smoky Mountains, which isn't a very far drive from Huntsville, and they're going to go spend money at Dollywood. Or maybe they're going to come down to the beach and they're going to come visit me and go to Gulf Shores and enjoy the summer sun. And they're going to spend money in the summer sun. So there's some leakage that's going to come out of that market as well. Well, what we're looking for is we're looking for more export sector jobs, money coming out of the market and feeding that market so that that leakage that occurs, we got more coming in than what's going out. And there's a great picture to depict this. Think of it as a faucet and a bucket. So that bucket's your market, okay? And that water level in that bucket, that's your local market. And notice there's a hole there, all right? So that's that leakage. That's Daryl taking his salary and he's going to the Smoky Mountains and he's going to Dollywood. That's Jim taking his salary and going to the beach and enjoying the beach, okay? So we have that leakage. We have to keep that water flowing with those export sector jobs or those basic jobs in order to keep that bucket full. Really, we want it overflowing. So you want to identify an emerging market, find a market that's got a bucket overflowing, that it's not stagnant, it's not level. So that's a level market is a stagnant market. But if the water is draining the entire bucket because you have a market that's just circulating its dollars, but people are still going out and spending it elsewhere, that's a declining market. That's how you truly identify an emerging market or not. And there's a little bit of math to do that. All right. Your other type of job, when Jim opened that bakery shop, that's called a support sector job. So we have basic jobs, which are export sector jobs, and we have non-basic jobs, which are support sector jobs. That's very important. When you go to bls.gov, you'll see a 2-digit NAICS code. So NAICS is the North American Industrial Classification System. So you identify, there's about 18 to 20 of them, depending on the market. Some markets only have about 12. The national is somewhere between 18 and 22. I can never remember that number. Those NAICS codes are what we identify whether it's a basic sector or not. And I'm going to explain that in a minute. So the first thing we have to do is identify the basic sectors. Then we have to calculate our total basic employment in order to get our economic base multiplier. So when we're identifying those basic sectors, there's something called location quotient. And if I tell you how to do location quotient, you're all going to leave me. Just know that when you're benchmarking against the United States is 1.0, and the local market, if it's greater than 1.0, and you'll see this at bls.gov inside the tables, you're looking for greater than 1.0, it's export sector. If it's equal to 1.0 or less, it's support sector. So we want to find the ones with the location quotient greater than 1.0. That will tell us our sectors. Sorry. You add up all the sectors. Let's say there's 7 sectors in the market that have basic employment. We add all those total jobs up for those sectors. That gives us our total basic jobs. Okay, that's where we are now. I told you, this is high level. Just stay with me. I know you're not understanding this yet. Once we have our total basic jobs for the market, we already know what the total jobs are in the market. The BLS tells us what that is. We divide those total jobs by those basic jobs. And what that does is it gives us our economic base multiplier, or our EBM. And we need that. Remember, I said we need 2 things. We need the EBM and the PER in order to do future. Well, now we've got our economic base multiplier. For this instruction, let's just say it's 4.0. Then we're going to calculate our population employment ratio. Now, you do not need to do step 1 through 3 to do PER. Go to bls.gov, get your total jobs, go to Census Quick Facts, get total population, divide total population by total jobs. That's your PER. For the sake of this, we're going to say our PER is 2.5. Okay. So there's 2.5 people per job in the market. All right. That's all that means. If our economic base multiplier is 4.0, that means that there are 3 support sector jobs for every basic sector job. So if I've got 1,000 employees coming, that means, and I got 4.0, that means I have 4,000, because I multiply that in total employees times 4.0 gives me 4,000. 1,000 of them are the basic jobs, the ones coming, let's say Airbus, 3,000 support sector. So that's that 4. Okay. So that's what that means. You always got to subtract out the basic jobs. All right. I know you're not getting it. It's okay. This is being recorded, and you can always reach out to me later. I also do a class on this, but we're not going to go into that. All right. So now we got our EBM, we have our PER. Let's get our future economic base. So the first thing we do is estimate what jobs are coming to the market. We already know Mazda Toyota is bringing 4,000 jobs to Huntsville, 3,000 already being hired. Okay. So right now we can go ahead and calculate those 3,000 coming to the market. Probably go ahead and even, because I think within the next 2 years, they'll definitely be full production. I even start calculating in that additional 1,000. So let's just say we got the full 4,000 coming to the market. We'll just use that. We go to our local economic development department, Chamber of Commerce, Downtown Alliance. You can use Google Alerts to send you employment announcements, things like that, or maybe layoffs, so that you can get the net. Now, COVID made us understand we needed to get the net. how many are coming, how many are leaving, whatever that net is. That's where we calculate our future basic employment. So now we know that number. We're going to say 4,000 for Huntsville. Okay, so we've got that. The next thing we need to do is estimate our future total employment. So remember, we had an EBM of 4.0. We got 4,000 jobs. 4,000 times 4.0 is 16,000 total jobs. That means the 4,000 basic jobs coming from Mazda Toyota and the 12,000 support sector jobs that are coming because of it, totaling 16,000. Once we identify total employment, we can then take our population employment ratio, 16,000, or our jobs, take our 16,000 jobs, multiply that by our population employment ratio of 2.5, tells us we have a total future population of 40,000. 16,000 times 2.5 is 40,000. Correct me if I'm wrong. I'm pretty sure that's what the math is. Okay, that's right there. Boom. I just predicted what the future population is going to be in Huntsville. So if that's Monroeville, and it wouldn't be, but let's say it was, and I started with 100,000 when I did my initial demand calculation. Well, now I just did my future. I take that 40,000 new population, I add it to my 100. So now I have 140 instead of just 100. And now I do my entire demand population my entire demand calculation all over again. And now I can estimate my future multifamily demand 2 years out. Okay. That's how simple it is. Questions? That's it. Yes, it's a lot. I'm sorry. I told you when I'm having fun, I go long.
Well, I learned one very valuable piece of information, David.
What's that, Jim?
I need to know a David Monroe.
So Jim just brought up a very good point. Is it your best use of time to become a market analysis expert? Or do you build a strategic partnership with someone who is a market analysis expert? That's all I'll say about that.
Yeah, I think you have a bunch of business cards, David, because everybody wants one.
Yeah, Roger
And
that. Good.
There is a question from Raymond. He asked you earlier. He said, can you give general strategy for each cycle, particularly cycle number 3? Also, do you agree with Lendl's generalization of the buyer-seller market analysis?
So his titles, yes, I agree with his titles. Anything else you learn from Lendl, throw it in the garbage. When it comes to market cycles, now there are some great resources that Lendl and Neil Bawa and some other ones provide that you can get some past data on. None of them give you future, not a one. And they're telling you you're identifying an emerging market without doing any future calculations. Okay, that's dangerous. Don't do that. You want to know where they're going? I'll tell you where they're going. Watch this. This is where they're going. They're coming here and see my future. Let's see. Housing. Oh, it doesn't show it. Okay. I thought Census Quick Facts would show it. So, oh, here it is. Population percent change. So there was a population change from 2010 to 2019 of 8.1%. They're probably dividing that by 9 and then multiplying that times 5 and telling you in 5 years this is going to be your population. You can't do that. That's the biggest piece of junk I've ever seen. There are some things you can go into ESRI and it will actually tell you what the projected population growth will be in 2025. Those numbers are out. Don't look at them. Don't just throw them in the garbage. Okay. All right. So let's go back to Ray. All right, Ray, I'm gonna go back one more. Let's go to my chart. I like my chart. I thought this came out really well. I drew this myself. I thought this came out well. All right. Recovery down here. You're buying. This is buyer's market. Okay. Lendl's right. Buyer's market phase 1. Okay. We are definitely buyers in recovery. This is where your distressed assets are. This is where the rents are really low. We know it's going to be coming up an upswing. Cap rates are up. Vacancies are up. It's scary down here, which means that's where we need to buy. When it's scary, that's when you want to be buying, okay? As we start to cross the long-term occupancy average and we get up here in expansion and we start to see some product coming to delivery, here's where your yield investors start coming in. So the REITs start playing. A lot of the REITs would play down here if they have the relationships to do the value adds. A lot of them are starting to play up here because now they're getting those yield plays, all right? So this is where the REITs are buying. So now this becomes seller's market. To coin Lindahl, this is seller's market phase 1. All right. Well, we can't get to buyer's market phase 2 until we go through seller's market phase 2. But in seller's market phase 1, rents are climbing drastically. Inventory's going down, down, down. If you try to go buy anything right now, there's no inventory. I don't care if it's single family, multifamily, it just doesn't exist. We find little trickles here and there. Seller's markets. Okay. Whether you're an oversupply or expansion, it doesn't matter. Your seller's markets are up here. Your buyer's markets are down here. Why? Because we're still here. We still have rent growth. Even though we're vacancies ticking up a little bit, you know, that complacency sets in. Sellers aren't really ready to sell yet. They still think they have the leverage. Buyers are starting to see what's happening. They're coming in with lowball offers. They're starting to get pissed off. The sellers and buyers start fighting more and more until we get below that long-term average. And then we get into the buyer's market. And then the buyer said, ha, sellers, I told you so. And we start buying down here. Okay. That answer your question, Ray? I know that was quick, but I went way long and I wanted to try to be as brief as possible.
Hey, David, real quick
yes.
question. So if I'm reading this correctly, different cities can be in different phases of the market all at the same time.
Absolutely. And Mueller shows us that. Here's different cities in different phases of the market all the time. And remember, I said a lot of your tertiary markets are going to be over here still. But then again, you're going to have some markets that are probably down here. You got some of these little itty bitty markets that were already hurting because retail was moving out, malls were going dead, and they were kind of living off of that because their industry left. A lot of cities in Ohio, upper Midwest, things like that, they really did bad in COVID because they were already kind of a lower tier market. And it was the lower tier that was really affected more than any other place other than downtown markets. So they were affected pretty bad. And you may argue some of those tertiary markets are down here. So yes, they're going to be all over the board.
And so having said that, that means that theoretically, and to use the old stock market analogy, to reduce risk, you're buying in all cycles.
Maybe not buying here.
Yeah. So when
you can buy here, you can buy here, and you can buy here.
Yeah.
If you're buying here, be a long-term holder. Don't be a 5-year flipper is what I like to call them. Your typical value add strategy. I call those 5-year flippers. If you're a 5-year flipper, you don't want to buy here. You want to buy here or here as a 5-year flipper because you may end up here in that 5th year. Now, just means you got to hold just a little bit longer. Right. You piss your investors off a little bit more, but you're darn sure not going to buy here. You're not going to sell here or here unless you're forced to. And so if you're buying, especially if you're buying here, if you're buying here and you get forced to sell here, oops, sorry. Sorry about your luck. Pay attention to the market next time. I hate to be so obtuse about it, but it's true.
So there is one more question from Vicky Bartek. What about calculating in the additional rise in number of apartment buildings or apartments?
When you're doing your future population or future calculation, you're going to calculate in your supply, those future numbers. Yes. You're just not going to do it in your existing. You just want, what is it today? What it is today. Remember that current calculation is just today. Tomorrow it may be different because we may deliver 100 units tomorrow. Okay, that's going to change that calculation. Just today, it's a snapshot. It's kind of like a cap rate. It's just today. But we're going to use that information to go do our future. Once we do our future, absolutely, we're adding in everything that's everything that's being delivered and everything that's being absorbed. Ray says, is it possible for a market to skip from phase 2 to phase 4 due to crazy situations like because of COVID? I'd argue, Ray, yes. I'd say a lot of those tertiary markets did skip from phase 2 to phase 4. Most of your major markets will be able to weather that a little bit, though, like they did. San Francisco and San Jose took a little bit of time to get here. They didn't come straight here.
So David, you had talked about the long bull market and that this is the longest one that we've ever had. But what we didn't talk about was the average length of the recovery. So if you're caught, say for instance, in phase 3, how long potentially before you're able to, or how long you have to hold on to weather that storm?
Okay, so, all right, that is a better question. I get it now, if that's what was asked earlier. So trying to get an average of the recovery, which would be from step 1 to step 11, that's harder to do because it's been different in every cycle. But pretty consistently between 12 and 24 months. So Mueller actually does a great representation of it. You got this long, easy slope and then a pretty sharp down. That's pretty indicative of what a real market cycle would look like. Unlike mine, where mine's more of a bell curve and pretty equal. I just thought it was pretty. But for Mueller, this is more accurate. So you may have anywhere from an 5 to 12 to 15 year, and who knows after what we just saw, maybe even 20 years, but then a real steep boom. So COVID showed us that. Now there's other factors that are affecting, and I think we got something else coming, but it was pretty quick, maybe we're at 12 months now, and a lot of stuff is already starting to recover. So apartment markets weren't really phased by it too much, except for some of those tertiaries. So a lot faster, again, 12 to 24 months typically, and then it's coming back up again. So you don't have to weather that down cycle very long. And primarily because government steps in and throws a whole bunch of money in the market. Can they still do that? I don't know. I guess we'll see. They're printing fools, though, I tell you.
All right, if you have any questions, please put it in the Q&A. And any of our live viewers, if you're watching, have any question, please comment so that we can ask David all those questions.
We can continue these questions if you want, Vicky, because I mean, it's already almost 10 after 6. If you want to let everybody come in and start some networking, we can continue questions there if you want.
Let's do that. I'm going to stop the Facebook. Let me see.